couple owns a home in a divorce and they have a first and second mortgage. Normally, the mortgages are considered each marital debts, and if the parties are going to sell the home, then those mortgages have to be paid off. And if the parties are going to refinance the home, those mortgages have to be satisfied for a refinance to happen. In either condition, if one of the parties is going to be keeping the home and they're refinancing the home to and paying the other portion, paying the other party whatever, half of whatever the equity is, if that's what they've determined is going to be the case. The reason that the second mortgage is normally rolled into determining the value of the home is because second mortgages are oftentimes taken out to improve the home. However, many times second mortgages are taken out, or home equity loans are taken out for other reasons that had nothing to do with improving the value of the home. And as a result, the party that's keeping the home is having their equity affected by the home because, or not their equity, but the value of the home is affected because the home was just used to collateralize a loan. If that's the case, second mortgage should really be looked at no differently than a credit card. It's just that the home was used to collateralize that debt. And in that case, the argument can be made that the payment of that second mortgage should be treated differently because it actually the funds that were borrowed against it were not used to increase the value of the home. This could be the case if the parties got a home equity loan to consolidate other debt. Maybe the parties decided they wanted to go on vacation and they took a loan out for that purpose. If for any reason those monies were not used to increase the value of the property, then the argument can be made that that amount should be backed out of the equation, and that the home value should not, or I should say the home equity should not be affected by that, the same way that your equity wouldn't go down in your home if you had an American Express with a $10,000 balance on it. You wouldn't necessarily say that the equity in your home is $10,000 less either. This doesn't happen very often, but it happens enough that if you feel like the second mortgage on your property was not used for the purpose of enhancing your home, mention that to the mediator so the mediator can give both of you some creative options on how to ensure that a fair distribution of equity based on an actual market value of that home and actual equity is determined.